What's going on, everyone? My name is Nicholas Merton here at DataDash, and today is November 12th of 2018. Well, folks, I hope you all are having a wonderful day wherever you are. It's time for a daily update here on the DataDash channel, and as always, we're going to be taking a look at market valuations as well as doing some technical analysis on the market leaders. But outside of this as well, we've got a variety of headlines to dive into. I want to spend some time to talk about Bitfinex, one of the most well-known exchanges in the cryptocurrency space, and some of the concerns that people have had in regards to withdrawals and fees. And along with that as well, I want to spend some time talking about traditional markets and talk about the growing interest rates in the United States and how that plays a large role on some of the major debt in the United States, whether it be consumer credit or all the way up to federal debt, and how it's going to have an even larger burden going into the next few years. So we've got lots of things to discuss. Let's not push it off any longer and dive right into the update. So going on ahead, guys, and taking a look at crypto markets in the past 24 hours, we really have no trend. There is obviously some players in the green, some in the red, but for the most part, we're not seeing any serious trend pickup. The only one that's really making serious moves and volume is NIM at the moment. And this is due to the fact that one of the old Japanese exchanges that had recently experienced a hack. I think it was CoinChecker, one of those that had experienced a hack from their NIM pair to their Japanese yen trading pair. They have resumed trading. They are now trading NIM yet again. So in this case, it has brought in some more money from Asian markets. It's gotten investors a little more optimistic that the security's probably gotten increased around it. So good to hear on that for NIM. NIM's definitely one of my favorite protocols out there because they're really set on actually getting utilized by a lot of companies. I've met so many guys as I've gone to conferences who work on the NIM project. But anyways, want to go ahead, spend some time to do a little bit of a market overview here. Market's still pushing sideways. In fact, you can see here the volatility index is practically down to the lowest point it can be. Again, I can't emphasize it enough, guys. Equities markets are more volatile right now than cryptocurrency markets. Think about that. Now, unless you're dealing with some crazy, low volume cryptocurrency, when we're talking about some of the more well-formed ones like Bitcoin, we are experiencing lower volatility than some of the major indices in the US. Now, I don't think this is going to last forever, and not to mention it's coming at a time where US markets are a little bit volatile, taking a little bit of a correction in over the past few weeks, but nonetheless, it does say something to see crypto getting down to such low levels of volatility. And historically speaking, when we see these kinds of levels, it definitely does usually prompt the idea that we're going to see something within a relatively short time frame. But I don't want to be speaking for anything too soon, guys. Again, you guys know I have my indicators that I'm looking for. It is good to see, again, that altcoins are following the same trend here, holding around $100 billion of valuation. And across the board, still holding a little bit less than 50% of market dominance, around 48% here, as Bitcoin is still holding well above the 50% range. Again, though, we are making lower highs on Bitcoin dominance, again, signaling as Bitcoin makes higher lows that markets might be ready to potentially make a move here in the next few weeks. And going into 2019, I think we're going to see something, but we're not going to see anything major until, again, we get above the 50 and 100 day, the 200-day moving average. Hopefully, we'll kind of push it off and wait to make contact with the logarithmic chart uptrend line that we talked about, and also hopefully make contact, seeing as we're so close to it, with the 100 week. And if we get a really solid bounce off that, that'd make me really excited for crypto markets. But we need some fundamental catalysts, as we've talked about, and I think you guys know generally what those are. Going on here to take a look at Bitcoin. Really loving the fact that we are still continuing to make higher lows here. I'll go ahead. I think I've got my drawings off here. Oh, it's accidentally, TradingView does that sometimes. It messes it up when I change the time frames, or I turn off my drawings. So we are continuing to make higher lows here. As we've seen on Bitcoin, we have escaped the resistance line here. It's just a matter about getting above these moving averages, guys. There's, again, no reason to overcomplicate it. Markets are coming in and buying at higher levels when it comes to the lows for Bitcoin, and we're getting very, very close to these moving averages. Again, I want to talk about kind of the struggle of getting over moving averages and how over time it can get either worse or it can get much easier to do. So, for example, I might have mentioned this in a previous daily update, but if we take back here to June, for example, in the sense of getting over the 200-day, which is a really confident indicator once you've gone below it and you get back above it, it's usually a time period for Bitcoin, as we've seen historically. We'll take a look at Bitstamp, and I'll show that in just a second, that In this case, you have a very wide range between the 200-day from this price action here. So we can see the price around here was generally around where we are right now, but the 200-day was up here at 10,000, and that's about a $4,000 gap. And with that, it's very hard to overcome something like that, right? You know, a $3,000 to $4,000 gap for Bitcoin in that case is multiple percentage points higher than where it is at the moment. Well, now that we've actually been pushing sideways, we've been holding price action very much close to where we were back in June, pretty much unchanged, and the 200-day is just a few $100s away. It's less than $1,000 away. In this case, it depends on what exchange rate you're looking at, but if we rough off Bitcoin to around 6,400, it's only $600. So in this case, we have a very, very short price range. If we make any 2 or 3 serious days worth of price action to the upside, we could have a very good chance of getting above there, making it support, holding it for a while to see if the market is ready to make an uptrend. And if you have some catalysts, it could definitely build up to a larger cycle. If you get traders trading it, people speculating, people buying in, that's the key here, guys. So again, no rush, not making any predictions. We're still pushing sideways, guys, as we really have here for the past few months throughout the summer and the fall. And now as we step into the winter, there might be a little bit of excitement, seeing as it's been well over almost a year since we've seen really the fruition of the bull cycle. So we need increasing volume, though, nonetheless. We'll go ahead and do a little bit of TA here, guys. Again, not much has changed since we last talked Ethereum. What I do like to see is that Ethereum is holding that 50-day comparative to Bitcoin. Very nice to see that for altcoins, showing that people might be getting a little bit more excited. I want to go ahead and see if I can bring some decent volume here. I think it's best to look at Binance to really get an idea of this. Not too much on the volume side, got to be fair, but I don't think you're going to get real serious increases in Ethereum volume until you get the announcement of Ethereum futures contracts, which should be coming hopefully by either the end of this year or the beginning of 2019. Going on here, let's go ahead and take a look at XRP. XRP still holding above all 3 moving averages. However, I got to be fair, guys, and I'm going to go ahead and take a look at the exchange for those of you who are concerned about making sure we have proper volume. I just don't see the volume here on Binance, and that does concern me. I do like to see that out of all altcoins, this one has been holding quite strong, and it's holding above all 3 moving averages. For the short term, this has been probably one of the most bullish players in the market, but XRP in this case really needs to get past this line of resistance at 9,000 Satoshis. When it does that, I'll definitely consider it for a trade in that case. I'm going to wait till it gets a close above there and really picks up momentum. I need the broader market to really move as well for me to get confident in XRP. Now, many of you have been asking about Bitcoin Cash, and I'd be happy to hopefully do a video here. I don't know why Binance isn't showing on here. But anyways, we can see here, obviously, much more volume has come in with the Bitcoin Cash fork. And I want to spend some time to explain a little bit about the fork, hopefully in tomorrow's video or sometime later down the road, just to kind of explain what's going on. Again, I don't give too much care for Bitcoin Cash, not trying to be rude to the community. I just don't believe much in forked currencies. But nonetheless, I will try to cover it if enough of you are interested, so you guys can let me know in the comments down below if you are. Alrighty, so I'm going to skip on doing much individual protocols, guys. Things haven't changed too much, but the moment we start getting some volatility, you guys sure know I will be doing as much TA as possible. Now, I want to spend some time here to talk about Bitfinex. Now, we all know, if you guys have been in crypto for a while, that Bitfinex has had some issues over the past. And a lot of people have been concerned as of recent. That concern has started to re-amplify again. We've started to see the issues with Tether holding its supposed pegged ratio. We've seen in the market that it dipped to 96 to 95 cents. We also have seen as well Bitfinex having some issues with withdrawals. And as you all know, Bitfinex over on Twitter, the anonymous personality who has been calling this stuff out for well over a year, has continued to point these things out if you happen to follow him. And though I don't want to just take the cynical mindset that he kind of holds on Bitfinex, I want to kind of take a kind of neutral view here, work with what we've got. I do have to say he makes one of the best points here in regards to the fact, and as a lot of the Bitfinex critics have brought up, that the concerning factors of Bitfinex have been on the rise as of recent. Again, as we talked about, people have had issues for multiple weeks now for withdrawing from what I've heard. And along with that as well, there's been an increase on the fiat withdrawal rate on Bitfinex to 3%. Okay, let that sink in. 3%. Now, if you withdraw with crypto, from my understanding, from what I've read, I think it's only like 1.5%. So they kind of slash it in half, or it's 2%. I can't remember the exact number on it, so don't quote me on it. But I do know that 3% is a very, very concerning number for a withdrawal fee. From my knowledge, I don't get anywhere near that kind of charge when I withdraw from any of the exchanges that I've used, like Coinbase or Gemini or Binance. I mean, this is just absolutely crazy to see this for these kind of fiat withdrawals. So I got to say, this is concerning to see. I think we have to wait and hear why Bitfinex is doing this. I don't know, maybe they're just trying to bolster profits in a low volume market. I don't know. But man, it is really not coming at a good time when there's already a lot of fears here. Now, this could also be to the fact that they've recently partnered with Deltec, who is going to be the banking partner for Bitfinex. As of now, they're a financial service company based out in the Bahamas, and again, kind of operates in the offshore world, which is what Bitfinex and a lot of crypto exchanges have to kind of deal with. Again, with Binance and Malta's very proactive towards crypto, and also previously gambling and a lot of other industries that governments won't support. So in this case, it's understandable why they have to work with something in the Bahamas. I'm not trying to fearmonger here, but what I am trying to do is explain that how, with a new banking partner, with the expenses that come behind it, possibly that some of those withdrawal fees are going to pay for that. We don't know. So just playing devil's advocate here, keeping neutral on both sides here, but there is definitely some things to be, I think, relatively concerned about with Bitfinex, as there's not much going on in the crypto space. It's what I would keep my eye on, and it's another reason why I'm not really trading Tether right now. Alrighty, so going out of crypto and going into traditional markets, I want to spend some time to talk about the rising rates across the board on the global economy, not just in the United States, but also in other economies, like rates, for example, like the LIBOR rate, which is really the short-term rate for borrowing capital. And I want to spend some time to talk about how this becomes a growing problem and really understanding the functionality of debt and interest over time and the threat that rising interest rates can really have. So let's go ahead and spend some time here. As we've talked about on the channel, we've talked about the well-known LIBOR rate. Again, to put it simple, guys, the LIBOR rate is generally what an individual has to pay. There's different rates in the LIBOR rate. There's the 1 month, 3 month, 6 month, and 12 month, if I'm correct on that. And basically, it's different rates that you pay on top of the capital that you're borrowing. So the interest payment, the cost to borrow capital at different time rates, these different time intervals. And we can see that these levels have reached, at least on the 3 month here, to an all-time high, and are back to levels that we haven't seen in 2008. Now, again, a lot of people tend to, try to make you think, just focus on 2008. Yes, we still have much higher levels. Again, this was the peak really of the bubble back in the 2000s rather than the crash in 2008. So we saw rates up here between 4 or 5%. So, we might have a ways to go on this before we really start feeling the pain. I don't want to sell you guys on that, but it's tended that historically we've seen LIBOR rates, much like base interest rates, going lower and making lower highs. So we're probably going to hit resistance around 3%, and if anything, maybe around 4%, but I don't really see it happening, and I'll explain why. So as we see these rising LIBOR rates, there is, as well as just interest rates across the board, whether it be on consumer credit or it be on federal debt, in this case, the debt of the federal government, it becomes a massive burden. And I think people sometimes don't understand the scale of this. Economists with, I think, a bit of a brain would have spotted this miles ahead, or at least understand this principle. But we're now just starting to really realize the ramifications of increasing debt and then increasing interest rates on top of that debt. So I'll go ahead and demonstrate how this can be a rising burden. I usually don't like to read too many things outside of Bloomberg and Zero Hedge, more kind of market-based things. Not a big fan of the New York Times, but I do appreciate that they actually talked about this. And it was the fact that as debt rises, the government will soon spend more on interest than they will on the military. Now, I want you to think about that for a second. And we're going to show how that happens and why it's going to happen, most likely, in the next few years. How you're able to spend more on simply making interest payments on money that was printed out of thin air, and you're going to be spending more on those interest payments than you're going to be paying on the massive, largest military that we have ever seen on the world stage. That really puts things into perspective, right? So, how does this happen, right? So let's go ahead. Let's spend some time. I'll go ahead and show you this diagram and explain, over time how within a matter of a few years, we're expecting the interest burden on our debt to reach levels that surpass our military sometime between 2022 to 2024. And again, maybe military spending changes over time, who knows? But how does something like this happen? And how is this going to become, within a matter of 10 years, almost a near $1 trillion burden? Well, it really happens due to the fact that the money that the federal government borrows is drawn in, the money that isn't brought in through tax revenue, that's brought in through raising capital in this case, thereby distributes treasuries, right? So the government gives out treasuries, or basically, IOUs in this case, to a variety of different participants who want to buy them. And those IOUs come with interest rates. So in this case, for example, we have the foreign holders, which is a total of 6.2 trillion. 1.18 trillion of that is owned by by China, and then also 1 trillion is held by Japan in this case. However, the largest single holder is the Federal Reserve, our own central bank in the United States. And then you've got a mix of people's, mutual funds, state and local governments, including pension funds holding it, private pension funds, banks, insurance companies, etc. Anyone who wants that clear, almost guaranteed rate of return, so long as the government in the United States is solvent and can make those interest payments. Now, in this case, this interest payment that you get on top of holding a treasury is known as the yield, in this case, the yield for holding that treasury bond. But it's important to understand, now that we see that there's a wide amount of holders who are receiving these interest payments, why that interest payment we have to pay treasury note holders is a burden over time. The yield that they have to be paid out on the annual basis. So I'm going to go ahead and, in a very simple way, we're not going to stick to so much the numbers in the United States. I want to more explain the principle, the actual reason why this is a burden. And you guys can crunch the numbers yourself. It's very simple. But going on here, I want to show you a demonstrated example. So let's say we're operating a government of some sort. This could really be anything, but let's just keep it simple, call it a government. And let's say that we've got, right here in our budget, we've got two things. We've got our revenue. So in this case, it would be tax revenue from our citizens, to our expenditures, right? So we have $1 trillion in tax revenue to go spend and $2 trillion in expenditures. So we've got a problem here. We have $1 trillion in revenue, but we do not have enough to pay for our $2 trillion in expenditures. In fact, we have a $1 trillion deficit. Okay, that's deficit spending, money that we don't have, but we are going to pay for this year. So how are we going to do that? Well, we've got to borrow money. We've got to go out and create treasury notes, sell them with the promise to pay some sort of yield on them, and we'll get capital in the short term to pay for our other $1 trillion in expenditures that we can't cover. So obviously deficit spending leads to debt in this case. So we have a chart here over time, just simple amplifying graph here where debt is increasing over time. Now, the reason why interest can become a burden is very easily demonstrated in this chart. So let's go ahead and let's do some labels here. Let's say, for example, that when we first started this deficit spending for our government, that we started out with no debt. And in this case, because of our first annual year, we're going to have $1 trillion in debt. So sorry, I hate this drawing tool. It sometimes messes up. So in this case, we've got $1 trillion in debt from our first year of operating. Well, in this case, we've been operating for a few years now, and the debt has just gone off the chart because we haven't been able to fix our budget deficit. And now, let's say the debt has skyrocketed to $10 trillion. Well, the interest burden on $10 trillion is going to be very, very different from $1 trillion, and I can demonstrate that. So in our first year, let's say that from the first year, we'll keep it very simple, our first year to all the way over here in the future, that the yield on the treasury notes are on an average of 3%. So for the entire debt that we have, it's about 3%. Well, in this case, if we really think about it, you would have on your $2 trillion deficit in this case, really a thin line that would go to interest payments in this first year, right? If we're doing 3%, it's not that much. It would be really simply if we have about $1 trillion in debt that we're taking on each year to fill in that deficit, then in that case, it would be $30 billion. Really not that much. It doesn't seem like a big deal. So $30 billion in interest payments, all right? on an annual basis. All right. So this is going to add on to our deficit in this case because we're borrowing this capital. Well, over time, as the debt is getting larger and larger, and we're taking on more and more debt, at least $1 trillion each year. If not, if the deficit's getting bigger, it's going to become an even bigger burden. If we come down here to $10 trillion, 3% of $1 trillion, $10 trillion is a much larger burden. In fact, you can simply do the math. It's a $300 billion burden, right? And that's being added now on an annual basis. So within a matter of a few years now, we've gone from having this small little liability of $30 billion in interest payments. Oh yeah, we'll get to that eventually. We'll pay it down to, oh my gosh, we're now spending $300 billion, almost nearly 1/3 of our annual deficit. You see where the problem comes in? You get this parabolic growth of debt, and the interest payment starts to consume more and more and more of your overall expenditures. So it plays a larger role in a growing deficit. And not to mention as well, let's kind of play, devil's advocate here. Let's say that things were a little bit worse. Let's say that the yields on the treasury note actually is rising, as it has been over the past few years. And let's say it goes up to something like 6%. A leap from 3 to 6% doesn't sound like much at first, but it's actually a double on the interest payments. So this means that we're going to be going from paying $300 billion all the way up to $600 billion on an annual basis, more than half of our original deficit. So again, I'm just trying to give you guys some example numbers here. This isn't the exact numbers of the United States, and again, things can change over time. You can have cuts to fiscal spending, you can increase tax revenue, but to be fair, guys, I'm going to let you all know about something, and this is kind of undisputable. The fact of the matter is we will never pay down the United States federal debt, and we will never pay back all the debt in existence, all of the consumer credit that's out there and being borrowed, all of these small and larger business loans that are being used at the moment. We will not be able to pay it down because, for those who understand how money is created by the creation of debt in this case. Money is debt, meaning that for every $100 you add in circulation, let's say that the interest rate, the Fed funds rate is 2%, there will always be at least 2% of debt in this case with our interest rate, or $2 of debt over the base $100 that will never be able to be paid back. So there will be $102 of debt and only $100 in physical currency. And how do you pay back the 2% interest? Well, you really can't unless you print more money and continue the process. So you keep piling up a big pile of debt. And that's exactly what's really happening here. But nonetheless, this will become a more larger talking point. This will question the solvency of the United States, and not just the United States, but a variety of other governments who have been on a borrowing binge across the world. So again, it's going to eventually expose itself over time, but this is what's really going on and how we can go from spending more on interest payments rather than our military spending. It's a very fascinating thing. I fell in love learning about this topic years ago. But I hope this helped at least explain a few things, and helps kind of, again, more than anything with these kind of headlines, take away the politics of it, guys. It's not so much whether you're spending money on military or healthcare in this case, or whatever you think is the leader of this issue, right? Some people like to pin and say, oh, this debt crisis is because of this person or that party. The fact of the matter is that what really plays a big role is this rising interest rate. We've had a large pile of debt for a long time in the United States. The past few presidential administrations and the underlying government below them has been on a spending binge over the past few decades. And now that's coming to roost with rising interest rates, mostly been drawn by the rise in interest rates by the Federal Reserve. So that being said, thank you guys so much for watching. I hope this was educational. Hope you guys enjoyed it. That'd be a good topic to talk about today. If you guys have anything you want me to cover in the next video, let me know down in the comments down below. But outside of that, I hope you guys are having a wonderful day wherever you are. Until the next video, I'll see you all in the next one. Stay tuned.